Good afternoon. My name is Jamie Bergen, and I'm part of the OpCo team here at Rosenberg Research. I am joined by two of Rosenberg Research's senior strategists, Brendan Livingston and Marius Youngstra. Brendan and Marius, amongst their many responsibilities, are both the creators and the curators of the publication called Strategizer that Dave Rosenberg and his team publish on a monthly basis. Welcome, guys.
Thank you, Jamie.
Strategizer has become a very popular read by our subscribers, and we get many questions on how to effectively use the product and how it's performed. The demand has been so strong, we believe that there was a need to create a quick video that we're doing today that can not only help our subscribers come up to speed more quickly, but to also introduce the research piece to those that are just simply curious. It's great timing too. Brendan and Marius just released the May edition, so it gives us a couple of real-time examples to illustrate the power of the model. So I guess to start, maybe it's best if you two gentlemen quickly introduce yourself and then give us a synopsis of exactly what the Strategizer is, its gestation, the methodology behind the research piece, and more importantly, tell us how you think people should be using the piece in general. And I guess from there, take it away, guys.
Perfect. Thank you, Jamie. So in terms of what is Strategizer, it is a monthly report that we produce here at Rosenberg Research. It is different than a lot of the other reports we produce. It is a purely quantitative tool, and it is well suited for active investors. We have here that its official definition. It's an effective risk management tool that provides scorecards and expected future returns. And we look at this across various stock markets as well as sectors. And we are also looking at bonds and currencies. And going forward, we have a goal of rolling out additional models. In the coming months, we'll be rolling out a credit model as well. And we also are planning to introduce some commodities models later this year. So I guess the big question is, what is it, and how are we producing our scores? So the basic construct of the models is that we are looking at each asset class across a variety of metrics that basically fall into five key categories. The first category is technicals. The second category is fundamentals. Third is valuations. Fourth is sentiment. And fifth is positioning. And basically what we're doing is we're producing a score across each of these five categories. And why are we doing this? Well, what we found is that when we look at all of these five categories, it basically gives us better signal in terms of predicting forward returns, which is at the end of the day what we're trying to do. And ultimately, what we're producing each month is for every single asset class that we have a model for, there will be a score from 0 to 100. Now, a 0 basically means very weak expected forward returns. And 100, of course, conversely means that expected forward returns are very strong. And just to emphasize, this is not a short-term tool. It's not a trading tool. What it is we're trying to make forecasts about expected returns over the next year. And with that, I'll pass it off to Marius.
Perfect. Thank you, Brendan. So I will just be going through some select examples of our latest report based on the end of April here. How to interpret the monthly results and basically overall how to use the product as a subscriber. So the simplest way is obviously to gauge the change in score from the month before, but also in the context of the return table, which you see at the bottom of the slide. How these model scores fit in our backtesting period in terms of corresponding future returns, especially relative to the median or the average that you see there all the way on the far right. So basically beginning with the US model as an example, what we see is a pretty modest uptick in the score last month. basically 5 points from 34.5 to 39.5. But more importantly, there's no corresponding change in the forward return profile. So overall, very neutral reading, still below average returns historically based on our back testing period, and an overall, relatively poor risk reward profile. Not something to get too excited about overall. So to us, if we were to interpret this results, even though we have had a correction to start the year, it's not really indicative that any kind of bottom is in place just yet. We still have a lot of overhang in terms of our underlying components, primarily the valuations category needs to improve rather significantly, probably before we get to some constructive readings and we start to get into those overweight or green portions of the model. For reference, though, we did start the year at a 2.5 score, which is basically almost as close to 0 as you can get. And those are, like Brendan was referring to earlier, those are more traditionally associated with very weak forward returns, below average. So we have seen some improvement, and for those that do have a higher risk tolerance or maybe even a longer time horizon than our 12-month outlook, you could start to think about scaling in, especially on further weakness. But the overall message, or how we would interpret this month's results, is that there certainly still is some more downside to go before you could really jump in and conclude that we're now at an excellent buying opportunity. Typically around scores around 70 or higher is what you'll need to see before.
And Maris, you can see that reflected by the the forecasted returns based on the current score only being 9.7%, well
That's
under the median average, right? So
that's right. Yeah. And so it's important to stress when looking at those forward return tables, in my mind, it's more so about how do those numbers relate to average or median, right? So this is, at the end of the day, it is still forecasting lower than average return profile. So we do certainly feel that there's more downside to go before we do get into more attractive risk reward profiles.
And Marius, one thing to add, did a great job summarizing that. But we have a box on the right there that shows where we were at the March 2020 stock market lows. And as you can see, that was a very good buying opportunity, obviously with the benefit of hindsight, but our model was saying it had a score of 95.3. So if you take that and you look at the 52-week forward return table at the bottom, you can see that on average, that's associated with a median 1-year forward return of 24.2%. So we're nowhere near that point in terms of being an attractive entry point. So that's right. Just something to reference.
That's right. That's exactly right. But we also do produce these sector rankings, which we also include in our Canadian equity model, but we'll just use the US here as an example. And this is primarily because while we may have a certain opinion, on the overall headline index, there's always going to be opportunities that exist beneath the surface, right? At the end of the day, this document is for active investors. So we need to come up with a way to identify these opportunities, even though, for example, right now you're not as constructive as we are on the headline. So the methodology here is essentially the same as the overall index. We have our 4 key categories that we rank each sector individually and then aggregate the scores to produce one summary ranking, which you see over there on the right-hand side. And basically, our back testing, again, reveals that you want to own the sectors that show up at the top. They tend to outperform versus those at the bottom. So from an investment implementation point of view, if you're a portfolio manager or investor, you may consider overweighting those at the top versus underweighting those at the bottom. Especially what we find is if they have consistent rankings. So if we go back to our current example, energy has been number one, not only compared to last month, which is what those numbers in brackets represent, but it has been number one since we launched all the way at the beginning of last year. So when you start to see consistent rankings for many months in these various sectors, it's an indication that the signal is relatively clear. And likewise, we see that as well with technology at the bottom. Technology has consistently ranked among the bottom four, which again, right now is one of the worst performing sectors in this corrected period. So if we continue to look at the results from last month, if I was explaining this to a subscriber, what I would highlight is not only the consistency between, say, energy materials that remain near the top, but we also saw an upgrade in industrials, which went from the 5th spot to number 3. So from the middle to the top group. We saw that with communication services, which went from the middle to the top group. And likewise, we actually saw a downgrade in financials from the middle to the bottom group. So those are worth looking out for, especially in the coming months, to see if those trends continue, and then if maybe there are some buying or selling opportunities in those sectors. Additionally, what was also interesting about these results last month is in the context of our overall view on the headline, on our headline model. So we're starting to see a bunching at the top. As you can see, we have energy, materials, industrials as the top 3. And these are more kind of, value in and inflationary hedges. But we also are seeing a grouping of defensive sectors creep up. So we're seeing real estate, communication services, which obviously includes the telecom portion, and healthcare. So we're starting to get this signal from the sector rankings that, this really is a market in transition, and, just maybe further sign that we haven't quite seen a definitive break yet, and that there is more downside ahead.
Mm-hmm.
And one other thing to add there. So like a long only investor might look at this list, and as Marius said, you want to look at the sectors at the top of our ranks. So that would be, this month it would be energy, materials, industrials. You could go long those with an overweight, and have an underweight on technology, utilities, and consumer discretionary. If you had more of a long short strategy, you could go long the top sectors and short the lowest sectors. So, there's basically 2 ways to add value. If you have an ability to go short, you can take an outright short position, or you can just go underweight as well.
That's right. So we'll just move on now to our bond duration model. Now, this would be basically the prime example of what an overweight recommendation would look like. So as we can see, we went from an already elevated reading of 87.5 at the end of March to 96.2 here at the end of April. So basically, our bond duration model is further increasing its overweight recommendation. And not only that, when you look at the return profile, we went from an already above average return bucket in the over 80 group to now in the highest forward return bracket. So that is using the 30-year Treasury returns as an example. But this is now the highest reading we've had since 2011, which you can see, excuse me, sorry. There we go. Which you can see there in the historical chart. So we're getting a pretty strong signal here, and this would be an example of what we would want to see if we were comparing to the US equity model before in terms of making an overweight call.
And Mary, so I guess it begged a question for me, with the inflation ticking up, the hawkishness of the Fed, what is really driving almost the opposite of what people are expecting from this model? Like, it looks like you need to go out and start buying the long end of the bond curve. It's like that doesn't seem to compute based on the current economic thing. So what's the variable in behind this driving that signal the most?
Right. So that's a good question. So for context, we started the year at a relatively neutral reading at pretty much 50, right on the mark. So at the time, our model wasn't really picking up a clear signal. We had some headwinds coming from the inflationary pressures and a hawkish Fed that was raising rates, which is obviously those two things don't typically translate well to treasury returns. We also had elevated reading of valuations at the time too, which was a constraint. But we did start to see signs of slowing economic growth, which, again, all else equal, those are positive forces for bonds. But there was no clear signal. But basically what's happened from the beginning of the year to the end of April is you've had a significant shift further in the Fed's planned sort of reaction function of monetary policy here. And a lot of that is obviously now in the price. And what our models are saying is that historically, the ability for it to go even further is limited. So a lot of this negative news is already in the price. On top of that, because we have had such a massive increase in yields, that valuation sort of overhang that we saw at the beginning of the year has also now disappeared. So, for example, our valuation composite went from a roughly 70th percentile reading to now down to 30th. So that's quite a big improvement in 4 months. And as we know, valuations, not a great timing tool, but they do have a significant relationship when it comes to forward returns. So the shakeout that has sort of happened, the capitulation that has happened in the treasury market for the last 3 to 4 months is exactly what you would need to see to start to take this counter consensus call in overweighting. Like, a lot of the bad news is in the price. How much worse can it possibly get? And now you might start to see some surprises the other way. And again, to bring it back to our US equity model as an example, just because it is a popular one that clients focus on, this is the kind of improvement that would need to be seen before you can start to get those higher readings of 70, 80, 90 or above, where you get those really good forward return profiles.
Right.
Marius, if you could actually go back a slide to slide 7. So if you remember, in contrast to the US equity model, at March 2020, we had a score of 0 on our bond duration model. So we were as negative as could be in terms of duration exposure. So we've come a long way. Yeah. And I think that's really worth emphasizing. And it's also worth emphasizing that this score of 96.2 is in the context of what we expect returns to look like over the next year. Making very short-term calls is notoriously difficult, and we're not trying to do that here. What we are saying is that over the next year, we think that based on our back testing period, that there's a higher than average probability that we're going to get some above average returns in the treasury market. So that's basically how you should be looking at a result this month. It's not to say that yields can't go higher. They absolutely can.
Of course.
But 12 months from now, we think they will be lower. And we think that as a result, that you're going to end up with some above average returns.
That's right. Exactly. And why you would want to overweight duration and focus on the longer end of the yield curve. And then if we just flip to the last example here, which is our US dollar model. So this would be the exact opposite of what we're seeing in the treasury model. So this would be a reading that is obviously extremely pessimistic when it comes to forward returns. It's as pessimistic as our models can get with a score of 0. And then when you look at the corresponding return table, it is, that's 3 percentage points below average with an actual negative return historically. So, of course, this would be related to the Treasury model. The same factors that have been pushing yields higher have also been pushing the dollar higher, insofar as central bank expectations of the Fed diverging with the rest of the world. So, insofar as our Treasury model is correct about the outlook and yields, it would also translate into a pessimistic outlook of the U.S. dollar. But this would just be an example of obviously extreme pessimism.
And one other thing we should highlight here is that, like, this month we have some very extreme readings. We have a 96 in treasuries, and we have a 0 on the US dollar. But if we were to flip back to, for example, our historical chart of our treasury bond duration model, you can see that, like, these sorts of extremes don't occur very frequently. There's only been a handful of them historically.
That's what you're looking for. Yeah.
Yeah, exactly. So these are the extreme readings that you want to see. They don't happen very frequently. And, like, if you look at any of our tables, like if you look at this bond duration model table, you can see that, between a score of 20 to 80, there is a range from 5.6% to 10.6%, but that's a difference of 5 percentage points. When you start getting to, sub 10, well, that's minus 6.6. And then on the other extreme, over 90, 29.3, like, as Jamie was saying, you're looking for these extreme readings. If we get a model result sort of middle of the pack, that's not really telling us a whole lot. When we get these extreme readings, that's what matters for forward returns.
Right.
That's right.
And I think Marius, in the respective time, I think you have the Canadian model up next, but I think the biggest point is that you just don't look at the U.S. dollar and bond duration, correct? You've got other products that are inside of the research piece, correct?
Of course, yeah. So this would be, as Brendan sort of alluded to at the beginning in the intro, we do span various asset classes. I focused on those 3 just as some examples because, while 2 of them were extreme in the dollar and treasuries, and then the U.S. equities is just one of our more popular models and just an example of what a neutral reading would look like. But we do have a Canadian equity model here, which would be an example of a more nuanced or subtle shift in scores. So when you look at last month, 38.4, 2 months ago in March, 38.4 versus 47.0 last month, 9 points, call it improvement. It doesn't seem like that much at face value, but when you go to the return table, it is actually enough to increase the forward return profile by one bucket, let's say. So you go from slightly below average returns to now average returns, which, again, it doesn't seem like much, but these are the small shifts that take place month to month that subscribers and clients should keep an eye out, and that we certainly flag in the write-up to the report, because it flags these steps in the right direction. So as long as we continue to see this, it's a worthwhile improvement.
Okay, this has been great. Thank you again for your time, Brendan and Marius. So that wraps up today's introduction to Strategizer. We will be posting this video on Rosenberg Research's YouTube page for safekeeping, where, by the way, you can find other interviews and presentations by Dave Rosenberg himself. Again, I hope that you found this to be helpful. But if you'd like to learn more about the Strategizer or learn more about the economic research produced by the Rosenberg Research, you can find it all on our website at www.rosenbergresearch.com, or feel free to reach out via email at strategy@rosenbergresearch.com. And again, thank you for your time, and we'll see you two gentlemen later.